Good morning, everyone, and welcome to today's webinar, Growing Your Market Share with Bank Statement Loans. My name is Rose. Next slide, please, Mark. Today in today's webinar, we're going to be learning a little bit about Sherr Mortgage Corp, and then we're going to be going into the huge market opportunity with bank statement loans. We are going to go through some real-world scenarios, and we're going to go through some of our loan products. And we are also going to we're going to do Q&A and answer your questions. We've received some questions when you registered for the webinar, so we'll try to address as many of those as possible. And then we will go from there. So please use the questions feature within in the webinar itself, the little tool, to submit your questions throughout the webinar, and we will answer as many as we can. And if we don't get a chance to answer your question, don't worry, we will follow up with you after the webinar. If you'll give us just one moment, there's a little issue with the slides lagging. So today's speaker is Mark Lutzi. He is our regional manager here at Sherr Mortgage Corp. Mark, go ahead and take it away.
Well, good morning, everybody. Thanks for being on the webinar with us. I'm excited to be here and talk about bank statement loans and Sherr and how we can partner together to grow your market share. So let me tell you a little bit about who we are. Sherr Mortgage Corporation is based here in San Diego. We have account executives nationwide, but we're here locally in San Diego for your ability to find us. We founded in 2015, April of 2015. I've been here since the doors opened, and we're currently lending in 23 states and growing. So Minnesota, I think we just added last week, so welcome, Minnesota. We have a highly experienced management team. Our executive team here was the executive team of accredited home lenders in the past. You may have remembered that name. We've already launched our first securitization in 2017, we're proud to say, and let's just talk a little bit about, actually what we do. As an originator, we decided to stay very focused into one source of mortgage originations, and that's non-QM. So we don't do Fannie, Freddie, FHA, HARP, VA loans. None of those are in our resume today, and we are purists at heart. We feel that being very successful at non-QM, you have to focus in on non-QM. So anyways, we average 700 plus FICO scores and LTVs around 70. The A-paper borrower of today is the core customer that we seem to be continuing to originate with. Let's walk you through what that kind of looks like. So our securitization statistics have a 708 FICO score, 65% average loan to value. We're looking at close to 60% of the portfolio was bank statement loans. Over 50% of it was purchase money. 20% was investor. And basically 65% of the volume we do today looks like the Alt-A business of early 2000s. So why non-QM? Well, the space is growing. It's one of the few spaces in mortgage today that actually is growing. It's expected to double, even triple in 2018. That's pretty exciting. With the rise in interest rates, the pipelines that everybody has seen over the last few years is changing. You're seeing the people that were disenfranchised without getting financing available to them now have the ability to get a mortgage with bank statement programs. So there's a great deal of borrowers with A-paper characteristics who cannot get approved with the agencies. So it kind of basically walks you through what a non-QM borrower looks like today. Some loan officers feel that non-QM is a 550 FICO score with a person at 80 LTV and just got out of bankruptcy, and they're looking for financing. That's not always the case. There's actually a number of people with high FICO scores, cash in the bank, and they're actually being turned down. So let's talk a little bit about our bank statement programs. So first of all, we decided to eliminate the pain point that these types of loans start with, and that is identifying the income. So we offer a pre-approval process for your loan. So this is before you can have to quote an interest rate and commit to your borrower. We're actually underwriting your income for you, and so that we have a number for your 1003, and we can identify your debt ratio and know that we would be able to proceed and commit to that loan. We don't ask for a CPA letter or a P&L, which is very competitive, as those two types of conditions not only slow down the process, but they're actually very difficult conditions to get. We do LTVs up to 90 with no MI. Borrowers do not have to have 100% ownership of their business. We actually allow them to have partners. We can handle borrowers with multiple business bank accounts. I've done loans up to 6 and 7 different accounts in one loan file. Variable expense ratio. This is a highly competitive way of looking at an expense ratio based on the person's employment. What do they do for a living? NSFs and overdrafts are not deal killers with Lynn Sherr. I'll give you some examples of what that looks like. So business owners and self-employed. So is there a market share out there for the self-employed? And after the Great Recession, small business and mid-sized businesses were going out of business at a pretty rapid rate. It's good to see that that's recovered, and not only is it recovered, it's growing. So our current economy is pushing new businesses in front of mortgage lenders all the time. So what's interesting is, what are these self-employed people doing, and who are we financing? Real estate agents, contractors, plumbers, properties investors, developers, attorneys, doctors, and CPAs. Yes, attorneys, doctors, and CPAs need bank statement loans. There's many more people working from home with very low expense ratios. They're even 1099, and they're having trouble getting approved for mortgages based on their tax returns. So how do you find these people? Well, it's pretty simple, believe it or not. Accessing free local directories, even the yellow pages, to find self-employed people would be pretty easy. But let's get into some other ways. Some neighborhood mailers, Yelp, Zillow is a great way to find real estate agents. LinkedIn, Facebook groups, these are your own personal circles where self-employed people exist. All you have to do is ask them some pretty fundamental questions and get a conversation going to see if you can help them with their mortgage needs. Business associations. Just think about the Better Business Bureau, local chapters. Every single person there is a self-employed business owner. So it would be great for you to be in a local chapter and help them with their mortgage needs. And how about this? Driving down the freeway. I have an hour commute, both twice a day, and as I drive to work, if I was an originator, I would tell you I'd have 10 qualified leads to call on by the time I got to work, just simply by writing down or taking a photo of the phone numbers of the trucks that I drive by every morning. So the self-employed, they want to hear from you. But why? Why do they want to hear from you? Because by and large, a lot of them have gone to their local bank and been turned down for either a purchase or access to their equity or to rate and term themselves into a better financial situation. So they want to hear from you. So what to ask? What do you say? How do you get these conversations started? And it's actually quite simple. We just wrote down a couple of simple ideas to get the conversation started. And basically, it's, have you had trouble getting a mortgage because you're self-employed? And if the answer is yes, then you just let them know that you can specialize in the self-employed and helping them achieve their goals. It's amazing how just that natural dialogue starts to come out, and a warm lead turns into a closed loan. If the answer is no, it's something for your Rolodex. If you ever have trouble in your future with a mortgage, I specialize in the self-employed with bank statement loans. I think I'll be able to help you. So just to kind of keep that lead source going is very important for you as an originator. So let me talk to you about a couple of loan scenarios that we decided to talk about that walk you through some of the pain points of a bank statement loan. The first one is a restaurant owner up in Fullerton. You can see he has a high FICO score. He wanted to purchase a property in Yorba Linda, California. Nice size loan, as well as putting 20% down. I ran into this loan because it had already been to 2 investors, and they both turned down the loan. And the reason so is they had NSF activity on their business bank statements. So it turned into 764 NSFs, which is really actually quite absurd. It's just almost unheard of. To the point where the owner of my company, Joe Lydon, said, would you please find out how somebody could have $24,000 in NSFB activity and run a successful restaurant? So I questioned from the broker. I called the borrower. We had a great conversation. And what I learned is that he actually would rather pay the $24,000 in NSF fees than the $45,000 a year salary for his bookkeeper. So it was a kind of a funny reply. I bounced that back off of Joe. Joe actually said that makes total sense, and he signed the loan, and it's been on our books ever since paying. So NSF activity, it is an issue in the industry. Some people are very rigid. It's something that we're able to have a discussion about. The next type of pain point that we see is multiple accounts. So the person I'm speaking to right now is a salon owner. He actually had 6 locations, and we have a decent FICO that wanted to do an investment property and a rate and term refinance. He was currently in a hard money loan. We were able to take 6 sets of business bank statements, apply an expense ratio with the rental income, and get them into a 6.5% interest rate. We saved the person almost $1,000 a month on his existing mortgage payment. So just to give you perspective, multiple accounts are an issue in the industry for bank statement loans. At Sherr, we're able to look at that, no problem. So let's move on to the next example. I'm having a delay here. Hang on a second.
There you go, Mark. It'll be okay.
Sorry about that. So variable expense ratio. This is a key competitive advantage at Sherr. We actually have a variable expense ratio based on profession. In this example, I ran into this loan after a presentation I did at a mortgage broker office. The loan officer came up to me and said, the lender that's currently working on it is hitting them with a 50% expense ratio. What would yours be? And I said, well, let's sit down and talk about the loan. The person's a psychologist. They have a $900 a month rent for his office space. There's no employees. There's no secretary. When you boil down the expense ratio, there's no way that it could come clear to 10%. So that's what we applied. The 67 debt ratio that was currently being calculated was now a 30-some debt ratio. We were able to close the loan within 15 days for that person. So it was a turn down to an approval just based on somebody's profession. We have a variable expense ratio for just about every profession you can think of, and that helps us gain more loans, more closed loans, and help you build your market share. So let's talk about partnerships and ownership, percent of ownership. Some lenders actually only allow for you as a borrower to be 100% owner, and also that they're not able to have any partners. So when it comes down to Sherr's methodology of bank statements, it can get complicated. We do a lot of loans where the borrowers have multiple partners. In this case, we had a dentist who had 3 partners, so a total of 4 with 6 offices. This loan became very complicated. We had 24 months of bank statements on all 6 locations, and then we took 25% of that income after the expense ratio, and that's how we qualified this dentist, who, by the way, bought a $2 million, it was a $2 million loan amount with 40% cash down and an 810 FICO. And yes, this person was having trouble getting financing. So just to let you know, dentists, lawyers, CPAs, they also have needs for bank statement loans. Mixed income. So here's an unusual situation. I'm talking a lot about bank statement loans and the pain points, but in this case, the pain point wasn't the bank statements. It was actually the complexity of the rest of the income. So let me give you an example. I have a CPA that worked from home, low expense ratio. We gave them a 10%, had a high FICO. His wife actually was a W-2 employee, and her paychecks were being directly deposited into his business account. So we removed those out of the total income, and we qualified her off the W-2 and pay stub. The loan amount was for $850. It was a cash out refinance. The cash out was $400,000, and we did it to a 75 LTV. But here's how we compiled the income. The $400,000 we actually asset depleted, and we took that income in a combination of the Social Security that was being deposited into that bank account, and we even grossed that up with the award statement. We used our rate cutter program, and we took the interest rate from 6.25% to 5.25%. The 2 points that we charged as discounts were financed on top of the loan, and it did not affect the cash out of the loan. And we compiled all of that income together to get to a 43 back-end ratio. this very complex income approach. So not always is the bank statement's going to be the issue on a bank statement loan. You're going to have a lot of married couples out there where one borrower is W-2'd and the other is self-employed. And how can you combine that income to get them to qualify? Well, we're experts at that. So things to ask, and how do you help your borrower? One of the things that I see in our industry today is loan officers learn how to do these bank statement loans because they're different. They're high touch. There's lots of questions. Are you abstracting the information that you need to at the right time? Because downstream, these borrowers start to feel like it becomes a complicated process. You don't want them to feel that way. You want them to know up front that you got your handle on what you're looking for. So let me give you some things that come up during a bank statement interview. Personal or business bank statements, and how do you know which is best to use? So you're not going to know that right on the front end. You're going to want to ask some questions of how the money is transferred in from a business. Do you pay yourself? You want to ask these questions so that you're understanding which accounts are going to be the best to use. So how many business accounts do you have? Like I said before, I've been involved with loans where somebody's had 7 different business accounts for one business. It's just all depending on what they're using those accounts for. Are there large deposits that'll need to be explained? So I've seen bank statements that come in with properties that have actually been sold. So you see a wire coming in for $500,000. Some people actually think that that's considered income. It's not. It's considered an asset. So there are other large deposits that are involved in a normal day-to-day business that are income. And an underwriter may want to know or may need to have explained what that deposit is. Learn that information up front just by simply asking, are there large deposits that you know of that we want to explain right away? Do you have any NSF activity? And if so, why is it there? A good letter of explanation is going to walk an underwriter through that. Do you transfer income from one account to another? And if so, why? I can't tell you, every day Lynn Sherr receives a loan from a loan officer with bank statement income, and the bank statement income is transfers. So the question is most people are going to say we can't use that as income. We actually dive down even deeper and say, where did the transfers come from? Can we get another account? Can I get a set of 24 months of bank statements for that income to actually use those transfers? A lot of lenders won't go through that complexity. Are there parts of the year that are busier for your company than others? So a CPA is a great example. So you're going to see a large amount of revenue during tax season and when those extensions are filed versus the summer months or winter months. And so as you are doing a bank statement audit on a CPA, you're going to see the ebbs and flows of that. And then lastly, this is one of the biggest ones in the industry. What account does the rental income go? And the reason that is one of the best questions is because somebody with a schedule of real estate and you're going to do a bank statement loan for them, if you're going to bring me a business bank account, the answer has to be there for where the rental income is going to be going. So if it's in that business account, that's fine. It's going to be abstracted and used to settle off the schedule of real estate. But if it's not in the business and it's just assumed that it isn't, it's going to be taken out of anyway. So you want to know where the rental income is going on a schedule of real estate on a bank statement loan. We got a little lag here again. Okay, so how to grow your bank statement business. I wanted to just basically put together a slide here on an interview that I did with one of our broker partners up in Orange County. This broker is very successful, has some radio advertising going, actually advertises for bank statement loans. When I sat him down and asked him how he was growing his business this year, I figured it would just be through the response of the radio ads, but what he told me was profound, and that is that it's referral based. And what I learned through that discussion was self-employed people know self-employed people. So if you're going to do a bank statement loan for somebody that's self-employed and you do a good job, they understand it was a high-touch loan as a customer. They understand that there was not a Fannie Mae proposition presented to them, and more than likely they've had the denial before you were able to even give them a solution. As you did that good job for that borrower is going to leave and recommend you at a higher rate than just a typical Fannie Mae full doc borrower. The reason so is self-employed people know self-employed people. So have you ever heard of the term family business or circle of influence? Um, it's just uncanny, but if you think through this process, the people that are self-employed know more self-employed people than a traditional W-2 person. The referral rate is much higher, and it's a way for you to look at growing your business with bank statement loans. So if I were a retail loan officer, I would be doing the following. So we talk a lot about this to try and help our loan officers grow their business. But calling on real estate agents, not only does it grow your purchase money business, but they're ultimately possible customers for you themselves. Building a strong internet marketing campaign, calling on local banks for referral business. So every local bank turns down self-employed people for their tax returns almost every day. So what an amazing lead source. You're non-competitive to them. You're giving them an ability to have one of their customers satisfied. Get to know some of your local bankers. I will tell you the lead source is tremendous. I passed by one of the best, calling on CPAs. What better lead than to have your borrower's CPA refer you to offer a bank statement loan to their customer? Talk about a golden lead. Get to know your CPAs in the local area. Let them know what you do and the services that you offer with bank statement programs. Huge lead source. Joining local business clubs, using LinkedIn, your own circle of influence. How many people are in your LinkedIn that are self-employed? All it takes is one quick nab to say, hey, have you had any trouble this year with your mortgage needs because of your self-employed? So targeting certain types of self-employed borrowers online and crafting targeted messages for them. Keep sending the message. Gain an identity. These bank statement loans, it's just going to continue to grow as this sector expands, and it'll be a great way for you to fulfill those missing rate and term refinance loans with bank statement loans. So Lynn Sherr has two programs for bank statement loans. I'm not going to get into the depth of them, but the Super Prime program is intended for 12 or 24 months bank statements. We can do owner-occupied loans up to $3 million. We have a 30-year fixed. We have a 5-1 and a 7-1 that are priced the same, and we have the competitive 40-year term on the IO plan. This program only requires 6 months reserves, and our expanded approval is designed for 24 months bank statements. I can even do investor loans on this program up to $2 million. Again, 30-year with a 5-year and the 7-year, priced the same, and with IO features for the 40-year term. Only 2 months of reserves required on that program as well. So other lenders versus Lynn Sherr, I don't want to really get into all the aspects of it, but I do want to just hit how flexible and user-friendly we are when it comes to bank statement loans. Again, multiple bank statements are permitted. We're not asking you to get an audited P&L. We're not asking you to have a CPA letter stating a percentage of expense ratio. We're not even going to a minimum of business expense ratios where the industry seems to be at 35%, but the average is 50. We can get as low as 10, and I've even had exceptions for 0. I'll give you an example of who that would be. So the borrower was a private pilot, flew for a company, and was 1099, 0 expense ratio. So the borrower must be 100% owner of the business entity, not with us. With others, it's the case. Bank statement analysis performed prior to 1003 underwrite. Again, we do a pre-approval on all bank statement loans. We vet your income. We give you that number. We're confident in that. And then we can move forward from there by disclosing the loan and then underwriting the loan. And then lastly, NSFs and overdrafts. They are serious issues, but we have the ability to attack that with common sense underwriting. So what makes Lynn Sherr different? Well, again, pre-approvals. We have a quick underwriting process, 42, 72-hour turn times. We have the ability to move fast. We have AEs that brag quite often about how many 7-day loan closings they've had, and they take great pride in moving fast. And so just to give you an understanding, a 15-day closing with us is very common, but we've been able to be TRIG compliant and still close in 7 to 8 days on a pretty normal basis. So anyways, common sense underwriting. I would tell you that the word on the street about Lynn Sherr is that we make exceptions. And if you give us the common sense of underwriting approach, what we use are compensating factors. And if a loan comes to me with four aspects, three of them good, one of them is in trouble for our guidelines, are there compensating factors for us to lean on to make that loan? The answer is yes. So, with everything I've said, I can confidently say we're an industry leader in the bank statement programs for self-employed borrowers, and we're looking to partner with you guys to help you grow your business. So, with all that said, I'm able to answer any of your questions.
Wonderful. Now go ahead and please use your tool, the questions tool, to submit your questions. A couple of people have asked me this one, so I'll just go ahead and answer it. Will you be sending out a copy of the presentation of the slide deck? Yes. I will be sending all of you a copy of the PowerPoint presentation, or actually a PDF of it, and a recording of the webinar so that you can share it. So that will be forthcoming. Maximum number of mortgages allowed. Mark?
That's a good guideline question. I would tell you that I can answer it in two ways. We look at a borrower's experience by their real estate portfolio is a good thing. So if somebody has 30 or 40 or 50 properties, that just means that that's exactly what they do for a living. They're very experienced. If all of those properties were financed, that would not be an issue with Sherr. So we do not follow the Fannie Mae thread of how many mortgages a borrower can have. Now we do have one guideline that's associated with how many Sherr mortgages we can give to one borrower, but I don't think that was the main question.
Wonderful. And no P&L, couldn't the borrower do one? If not, what is the self-employed questionnaire?
Yeah, really good question. So we do not have a P&L requirement on any of our loan programs. If a borrower wanted to supply us a self-created P&L, it's fine with us. But that's not how we're going to formulate our bank statement calculation. Then that goes to the second part of the question, which is what is the self-employed questionnaire? So that's not available on our website, and that's something that we ask our borrower to fill out on every bank statement loan. There's basically 7 to 8 questions walking us through the business. The first part of the questionnaire is, well, what type of business is it, and what exactly do you do? Then we ask for how many employees you have. If you own a building or rent a building, what would be the mortgage payment or rent payment on that? We kind of associate the answers to that question to how we're going to develop the expense ratio.
Okay. Do you lend in the name of an LLC?
Yeah, so we've seen a rapid increase for the requests of closing in an LLC. So we have a additional fee, I believe it's $795 to be able to do that. And then we prefer to have the LLC vetted on the front end. A lot of misconceptions about how easy that is to do. If it's done up front during the underwriting process, it can be very easy. If a broker asks us to do that while we're putting out a CD or asking for loan documents, it becomes very complicated. So that's just a little tidbit for any lender that you work with. Yes, we will allow the LLC. There is a fee, and try and get that done during the underwriting process.
And what about rebates from the lender? Can you shed some light on that? I think they're referring to the points.
Okay, so well, if they're referring to lender paid, we do have a comp plan of 2, and we do offer lender paid and borrower paid. So we also have some pretty sophisticated rate buy down programs, which we're probably going to do a PowerPoint on or a webinar on in the future, called Rate Cutter. And what that is simply is we have the ability to buy down an interest rate 100 basis points for 2 discount points for Sherr, and then Sherr finances those discount points on top of the loan. So for example, if it's an 80% LTV loan and the borrower wants to go from 6% to 5%, we'll give them the 5% rate, charge the 2 discount points, and you're at an 82 LTV.
Okay, great. And how quickly can you close?
I love being asked that because I like loans moving as fast as possible. So I stated earlier that we've closed a TRIG compliant loan in 7 days. I will hold a candle to that. So as long as we're working with an originator that wants to move as fast as we do, I haven't been asked to hurry up on our end. We have a very streamlined process with our account managers working hand in glove on any approved loan to get it to get it to CD, docs, and of course funding as fast as possible.
Okay, great. Does the borrower have to be self-employed for a bank statement loan?
Yes, that is one of the true technicalities of the product. The self-employed it has to be a self-employed individual. A lot of people get confused that a 1099 person is not technically self-employed. To us, they are. So any self-employed person, including 1099.
Okay, great. Does fluctuating deposits hurt the file? Are we looking for uniformity in dollar amounts?
Well, uniformity is obviously an easy underwrite. The fluctuations depend on the profession. So like a real estate agent that closes 3 homes in 1 month and then nothing for the next 90 days, it just makes for you to understand the profession. Everything that makes common sense to us is a very easy process for us to underwrite that loan. I've seen complexity where there are deposits that just don't make sense. So we start asking questions. When we get those answers, usually we're able to even work through that income as a source of income as well.
Okay. And can a loan be tied to multiple properties?
Can a loan be tied to multiple properties? So cross-collateralization, that's not something that we have available. We originate loans for our securitization, and cross-collateralized properties aren't allowed.
Okay, great. And then Thomas wants to know how we can how to contact us. We're going to go ahead and send out our contact information out to everyone who attended the webinar. I'll make sure to include Mark's phone number if you guys have any follow-up questions. And also, there's lots and lots of information on our website. So I think that's about as much time as we have today. There's a couple of very specific scenario questions that I got, and I'll be passing those along to Mark, and we'll answer those for you offline. So unless there's any more questions, we will go ahead and end it here. Thank you, everyone, for joining us today, and we will contact you with the slides and our contact information, and please keep an eye out for our next webinar next month. Thank you.